And welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, it's zinniawealth.com, Zinnia wealth.com. Tool around there a little bit. There's a button there that says menu. Click on that. You'll see useful resources, useful guides. There's a lot of information if you're up against a decision about Medicare, if you have a pension, if there's lots of stuff there for you to comb through. And also give us a call at 833-368-3680 to get your questions answered and to start planning for your retirement. Well, Sharice, you said it in our first segment, and that is that as interest rates go up, bond values go down. And that's where a lot of people are finding that they have problems within their portfolio. After all, if interest rates are at 5%, who wants your 2% bond? Nobody. And you got to sell it for a discount. Well, look at this. This is from Bloomberg, and it says people who have long-term bonds, like with maturities of 10 years or more, those bonds are down 46%. If you have a 30-year bond, that's down an average of 53%. Those are huge numbers. In other words, your bond values, your bond portfolio is now having its own version of 2008. And a lot of people have that classic 60-40 portfolio, 60% stocks, 40% bonds. That literally means almost half of your money is having a 2008. Sharice, that's just no way to get through retirement. So how do we change that?
Oh, how the time has changed, Randy, in the bond world.
Yes.
So let me just clear something up for the listeners, because you said there was a 10-year bond that lost 46%, a 30-year bond lost 53%. So let me just say this. There's different kind of bonds out there in the market. And if you do buy a straight, hey, I'm buying a 10-year, for example, Chevron bond, and it's lost 46%. You do need to know you're seeing that value cut in half. But as long as you hold it the 10 years, in 10 years, you get the face amount that you bought it for, right? But if you sell it right now midway, you lose 46%. And the same thing with that 30-year bond. If you bought a 30-year bond, let's say it was an 18D bond, and the bonds are changing. Now you're 15 years into it, and maybe you're 70 years old and it's paying like a 5% coupon and it's lost 53%. It's the same rule. If you hold it for 30 years, then that's the wonderful thing. You'll get your face amount. The 60-40 portfolio, there's very few people. I will tell you, I saw my first person for the very first time who had real bonds like that in their portfolio. And I said, okay, yes, there's volatility in your bonds, but this is okay as long as you plan to hold it. They're only making 3 or 4%. I'm like, I don't even know if that's worth it anymore. But for them, they were getting like 5 or 5.5%. So I said, hold it. You're a conservative investor. You'll get your coupon every year and just hold it till the end of the term. So it works. But where that 60-40 portfolio fails on the bond world, it's the mutual funds, Randy, and the exchange traded funds. Because the mutual funds and exchange traded funds, if 40% of your portfolio is in bonds, those mutual fund managers, let's say I'll just pick on one, the American funds and Fidelity. I'll pick two good ones. And those bond managers over at those companies are sprinkling in a 30-year, a 10-year, a 20-year, an aggregate bond, a treasury bond. They're mixing it all up. So it's long-term, but you have no control over it. Those are the ones that are crippling portfolios the most. Those are the ones that most investors won't stay committed to. And shame on those fund managers. They should have been selling those and investing in short-term bonds inside those mutual funds, but they don't do that. You think these mutual fund managers, Fidelity and American Funds and Franklin, do that, but they don't. That's why you've lost so much. Those bonds have lost an average, Randy, of 15 to 25%. So if you have a 60-40 portfolio and 40% is in exchange traded funds or mutual funds, you lost 10 to 20% from today, okay? So this is why it's okay in a portfolio to have a buy and hold strategy. You're going to hold for the long term. You know you're not going to need it for 10 or 15 years. A more shorter term 5-year strategy where, in my opinion, that's an active managed portfolio. Like somebody saying, hey, you have 4 sectors in your portfolio and one of the sectors is changing and it's time to get out of that sector and go into another sector that most likely could possibly do better over the next 6 months in the sector you're in. So I believe in active management. That's what we do here at Zinnia Wealth Management. And I also believe in the safe money strategies. On our active management portfolio, we've always had bonds. If you had a 60-40 portfolio, the 60s in equities, the risky stuff, 40s in bonds. We are different, Randy. And I do pat myself in the back because I love this kind of stuff. Just a couple of weeks ago, we did a massive sell on all of our actively managed Zinnia Wealth models. And anybody who's in those models, all were treated the same. And we bought a different type of treasury. We, because we like the tips right now. Mm-hmm. And there's a ton of them out there. Fidelity has them, iShares has them, Spider has them, Vanguard has them. Which one do you choose? And there was one among 20 of them that stood out based on what that fund was managing in. And I said, I like this one because this one makes sense to me. It's buying these short-term treasuries. It's doing all the right things. There's less wobble in it. And year to date, it's already made 5% yield, which is crazy because all the other companies, they only average 2 to 2.5. So where Zinnia Wealth really gets into, you get the scalpel out, everybody. I'm like the doctor of finance here. I get that scalpel out, and it's not just putting you in and throwing darts, in my opinion. I am actually taking my time personally, and I'm talking to our CFAs, making sure everything seems right, which they always say, great job, Charisse. We weren't even looking at that aspect, to try to mitigate risk as much as possible, which is so hard to do in this time period, but at least have a higher rate of return on our safe money if possible. And so that is something I am very proud of that we do. And I've learned it. I've been coached up. I've talked to the Yale professors. I've learned some of their philosophies, and we apply it here at Zinnia Wealth Management in our active managed portfolios. Let's just talk about sector rotation, everybody. I love sector rotation. Sectors, there's really basically 11 sectors. You have utilities, you have commodities, you have real estate, you have financials, you have healthcare, you have energy. You know where I'm going, 11 of them. And a big part of our portfolios, our actively managed portfolios, are heavily weighted in those 4 sectors. Is any of your advisors doing that? Because what they're saying is, let's pick the next best stock. Let's pick this stock. Let's pick this stock. And then it's wrong, right? And then you're wondering why you're down. Why aren't people focusing on sectors? Because if sectors is what's moving the economy, that's what you should go in. So let's talk about the next sectors for the next 3 months. Utilities is a great sector. Those are like the Duke Energy, Southern Company, electric. You guys are always going to pay your bills, right? Well, that sector is down at 15 to 18% today. I am wondering, based on all my math, if you all think that sector could grow over the next 3 months, knowing that, or if that's the next best sector. I'm not telling you to do it. We're still weighing out our options here at Zinnia Wealth on our next moves. But every quarter we are analyzing and digging in, is it or is it not? Not saying we're perfect, but if we get 2 out of 4 calls right, we're in the money. We're doing good, right? At least somebody is thinking. At least somebody is doing something. And it's just not a stock jock, we're going to buy all these funds and good luck. And we'll do a rebalance once a year. We do rebalances 2 to 4 times a year, by the way, on top of that. So what kind of retirement planner do you want managing your portfolio? The stock jock, the insurance agent, or the actual wealth management firm that actually cares about what the heck happens to those darn portfolios and puts a lot of energy into it? That's the one I would pick if I was getting ready to retire or I was in retirement. Because it's about making money, but protecting your money, right? We don't need double-digit returns every year. As long as we can protect from double-digit losses, that's the biggest thing I care about. And that's why sequence of returns is one of the biggest risks in retirement. And we teach you that when you come into our office. It's a very, very important piece of our education that we add on. So be careful with bonds. If interest rates go up, they're going to keep losing. Bottom line, they're going to lose 4 to 6% every time interest rates go up 1%. So do you take the loss now and invest in something else that might be going up? Well, I'm not going to give you the answer. That's something you have to come in and sit with me or our advisors. We're going to talk about it. We're going to dig in. We're going to see where you stand. We're going to look at your fees. We're going to figure out, number one, how to even cut your fees. Because if you lose 10% and you got a 2% fee, you got to make that 2% before you can even try to earn that 10% back, right? So fees are a big part of the picture. There's a lot that goes in here, you guys. And with all the noise out there, just be careful. Trust who you're working with. And if you have just a weird gut feeling, maybe it is time for a second opinion review, and it is time to come in and see us and we've had plenty of people walk in. I'm like, man, you got a good advisor. I was just in a Villages last week and I said, oh, I really like your advisor. He's actually doing a really good job. I'm like, I want to earn your business, but it's not broke. There's nothing to fix. That's what I tell people. And man, that goes a long ways. And I'm telling, he's already referred a bunch of clients because he appreciated it. And it's just the Zinnia way.
Well, as Sharice has been talking through that, and you kind of listen and you look at yourself in the mirror and say, do I have that? Do I have that advisor right now in my life that is saying, okay, there are places right now with opportunity. There are places where we have to protect your money. There are things out there that we usually don't use that we can use now because these interest rates are up. This is happening across some of the financial industry. I was looking through an article, and it was from Financial Advisor magazine. Now, if you look at what Sharice calls that stock jock, that person is going to want to keep you in the market. And that's that person that's going to say, hang in there. It's going to come back because they have that way to get paid. The more money you have at risk, the more they get paid. But in this article, it says, is your financial advisor exploring the opportunities outside the market? Here's some quotes from the article. Financial advisors are now leaning into fixed income investments with an intensity not seen in more than 10 years. And the last one I love. Before 2023, portfolios for recent retirees in their 60s were typically 60 to 70% stocks. Not anymore. Sharice, you talked about sector investing. Would you consider fixed income a sector that we have to be looking at right now?
I would consider fixed income an asset allocation, an asset class we have to pay attention to, because even in the fixed income world, you can choose sectors inside the fixed income world, which is even more interesting. So we have asset classes first. We have your bond, you have your equities, you have your commodities, you have your real estate, you have your, treasuries, et cetera. And then inside those bonds, if that's what we're talking about in fixed income funds, we also want to pick the right sector if we can on those funds. So yes, there's asset allocation and sector rotation to me that you got to have them both, number one.
Well, we would love to have that opportunity with you because so many times people will come in and they'll say, I'm just not comfortable in this stock market. Well, if you're going into retirement, you have to have your money grow somehow. How do you do it? Well, maybe fixed income is the place to look. And if your advisor's not talking about it, Sharice will talk to you about it. You go to zinniawealth.com, ZINNIA wealth.com. There's a gold box there and it says a complimentary retirement consultation. Let's just have a conversation. Find out what you're concerned about. Find out what you've done for retirement, and let's see how we can help. 833-368-3680 is our number. 833-368-3680.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 803-368-3680 or find us online at zinniawealth.com.
Sharice Rivers is an investment advisor representative of Zinnia Wealth Advisory, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Sharice Rivers is licensed in your state, please contact their office. Zinnia Wealth Advisory, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client. They are not meant to imply or suggest you will experience the same results. By contacting us, you may be provided with information about insurance and annuity products offered through Sharice Rivers, NPN Insurance License Number 8718011.